On May 25, 2026, something is expected to shift quietly inside the United States financial system, and almost nobody is going to notice it when it happens. There won't be loud breaking news alerts, there won't be dramatic countdowns, and there won't be viral headlines screaming panic. Instead, it's going to be subtle, silent, almost invisible. But the effects will not be invisible at all. People will begin to feel it slowly, not in a headline, not in a tweet, but in their everyday life, in the cost of living, in the value of their savings, in the pressure on their income. And by the time the average person realizes what's actually happening, it will already be too late to properly react, because the people who understand how money works don't wait for headlines, they prepare before the shift becomes obvious. So the real question is, what exactly is happening on May 15th, and why does it matter so much? Because this is not just another policy update, this is not just another financial headline, this could be the beginning of a deeper shift that impacts interest rates, inflation, asset prices, and ultimately your ability to build or lose wealth over the next decade. To understand this, we have to start with the foundation, and that foundation is the Federal Reserve. The Federal Reserve is the central bank of the United States. It controls monetary policy, it influences interest rates, it has the power to increase the supply of money or reduce it, and in many ways it sets the tone for the entire global financial system because the US dollar remains the dominant currency in the world. But here's something most people don't fully understand. Despite its name, the Federal Reserve is not a normal bank. You cannot walk in and open an account. It is not a reserve sitting on piles of cash, and most importantly, it is not directly controlled by the federal government. That independence is critical because it means political leaders cannot directly dictate monetary policy. Direction can change. That is why May 15th becomes such an important date. This is when a leadership transition is expected to happen, opening the door for a new chairman to take control. And a new chairman does not just continue the same path automatically. A new chairman brings a different mindset, a different strategy, a different approach to solving one of the biggest financial problems facing the United States today. And that problem is debt. Right now, the United States is dealing with an enormous national debt. We are talking about tens of trillions of dollars. But the real issue is not just the size of that number, the real issue is the cost of maintaining that debt. Because debt comes with interest, and those interest payments have become one of the fastest growing expenses for the government. Today, the United States is spending over $1 trillion every single year just on interest payments. That means a massive portion of tax revenue is not going into building infrastructure, it is not going into innovation, it is not going into improving public services, it is simply going toward paying for past spending. And that creates a cycle that becomes harder and harder to escape. As debt increases, interest payments increase, and as interest payments increase, the government is forced to borrow even more just to sustain itself. So now the question becomes, how do you deal with a problem like this? Most people assume the answer is simple, just pay off the debt. But that is not how governments operate, and history shows us this very clearly. Governments rarely eliminate debt in a straightforward way. Instead, they manage it, they restructure it, and in many cases they reduce its real value over time without actually paying it down in full. And this is where a concept called financial repression comes into play. Financial repression sounds complex, but the idea behind it is actually simple and very powerful. It is a strategy where policymakers allow inflation to run higher than interest rates for a sustained period of time. When this happens, the real value of money declines, which means the real value of debt declines as well. Let's break that down in practical terms. If inflation is running at 5%, but your savings account is only giving you 2%, you are effectively losing 3% every single year in purchasing power. Your bank balance might look stable, it might even grow slightly, but what that money can actually buy is shrinking. This is the hidden effect that most people do not notice until it is too late. And while savers are losing purchasing power, the government benefits because it is paying back its debt with money that is worth less than when it was borrowed. This is not a new idea, this is something that has been used before. After major economic disruptions in the mid-20th century, The United States had extremely high levels of debt relative to the size of its economy. Instead of aggressively paying down that debt, policymakers allowed inflation to remain elevated while keeping interest rates relatively low. Over time, the economy expanded, asset prices increased, and the ratio of debt to economic output became more manageable. The debt did not disappear, it simply became less of a burden relative to the size of the economy. But there was a trade-off, and that trade-off was paid by savers. People who held cash or relied on fixed-income investments saw their purchasing power decline year after year. Meanwhile, people who owned assets experienced the opposite effect. Stocks, real estate, and commodities increased in value over time, allowing investors to preserve and grow their wealth despite inflation. This is the key insight that most people miss. Inflation does not destroy wealth equally, it redistributes it. It shifts value from people who hold cash to people who own assets. Now fast forward to today, and the situation becomes even more interesting. The current debt levels are even higher relative to the size of the economy than they were during those historical periods. That raises an important question. Could we see a similar strategy being used again? Because if we do, it would have massive implications for how individuals should manage their money. One potential approach involves lowering interest rates. Lower interest rates reduce the cost of borrowing, which makes it easier for the government to manage its debt. If borrowing becomes cheaper, the pressure created by interest payments is reduced. But there is a critical detail here. If interest rates fall below the rate of inflation, we enter a financial repression environment. In that environment, holding cash becomes a losing strategy. Money in savings accounts loses value in real terms, which encourages people to move their money into assets that have the potential to outpace inflation. This is how capital begins to flow into markets. Stocks, real estate, commodities, and other investment vehicles become more attractive because they offer the possibility of growth that exceeds inflation. But this is only one part of the picture. Another important factor is the Federal Reserve's balance sheet. Over the years, the Federal Reserve has accumulated large amounts of government debt by effectively creating money and using it to purchase Treasury securities. This process increased liquidity in the financial system and supported economic activity. However, if the Federal Reserve begins to reduce its balance sheet by selling these assets, it could pull money out of the economy. This could help control inflation, but it also introduces complexity. If the Federal Reserve is no longer a major buyer of government debt, other investors must step in to fill that gap. Private institutions, foreign governments, and individual investors will need to absorb that supply. If demand is strong, the transition could be smooth. But if demand is weaker than expected, it could lead to rising interest rates, which would create a different set of challenges. This is where uncertainty becomes a key factor. Economic systems are not perfectly predictable. Policies do not always produce the intended results. There are feedback loops, market reactions, and external influences that can shift outcomes in unexpected ways. And that is exactly why periods like this create both risk and opportunity at the same time. There is also another variable that is increasingly being discussed, and that is technological advancement, particularly artificial intelligence. The argument is that improvements in technology can increase productivity, reduce costs, and improve efficiency across industries. If businesses can produce more output with fewer resources, it could help offset inflationary pressures even in an environment with lower interest rates. In theory, this could allow policymakers to pursue growth-oriented strategies without triggering excessive inflation. However, the real-world application of this idea is still uncertain. Technology can drive efficiency, but it can also create disruptions, displace jobs, and introduce new economic dynamics that are difficult to predict. So now the question becomes, what does all of this mean for you as an individual? Because at the end of the day, these large-scale economic shifts are not just abstract concepts, they directly impact your financial life. They affect the value of your income, the cost of your expenses, and the growth potential of your savings and investments. If we enter a period of financial repression, one thing becomes very clear. Doing nothing is not a neutral decision. It is a decision that can carry risk. Because in an environment where inflation outpaces interest rates, money that sits idle gradually loses value over time. This does not happen overnight, it happens slowly, which is why it is often ignored. But over the course of years, the impact becomes significant. This is why awareness becomes such a powerful advantage. People who understand these dynamics can adjust their strategy. They can make informed decisions about how to allocate their resources. They can balance saving with investing in a way that protects and grows their wealth. This does not mean taking reckless risks or chasing trends. It means understanding the environment and positioning accordingly. Historically, over long periods of time, assets have tended to outperform inflation. This includes equities, real estate, and certain commodities. That does not mean they move in a straight line. Markets experience volatility, corrections, and even major downturns. But over extended time horizons, they have shown the ability to grow in real terms. And that is the key objective in an inflationary environment. Not just preserving nominal value, but maintaining and increasing real purchasing power. This is where opportunity begins to emerge. Because during periods of uncertainty, many people become hesitant. They delay decisions, they hold excess cash, they wait for clarity that may never come. Meanwhile, others take a more strategic approach. They recognize that uncertainty is not just a risk, it is also a source of opportunity. They focus on long-term trends rather than short-term noise. They look for value when markets become volatile. They understand that economic cycles create moments where assets can be acquired at more favorable conditions. So what should you take away from all of this? First, pay attention to direction rather than noise. Headlines can be misleading, but underlying policy shifts matter. Second, understand the difference between saving and investing. Saving provides stability and liquidity, while investing provides growth. Both are important, but relying on only one can create imbalance. Third, think in terms of ownership. Owning productive assets has historically been one of the most effective ways to build wealth over time. And finally, remain adaptable. Economic environments change, and strategies that work in one period may need to be adjusted in another. The goal is not to predict every move, but to stay informed and responsive. Because at the end of the day, the biggest financial shifts do not happen overnight in a way that everyone can clearly see. They happen gradually, beneath the surface, until eventually the effects become impossible to ignore. And by that point, the people who prepared early are already ahead. That is why moments like this matter. They are not just about policy changes or leadership transitions. They are about understanding how the system works and how those changes can impact your financial future. And while most people will only react after they feel the effects, the real advantage belongs to those who prepare before.